Hi, good day to all. Welcome to Module 7 of Trade the Markets Like a Pro, a series of educational webinars. In this Module 7, I'll be covering multi-time frame trend trading strategy, building on the foundation modules of Module 1 to 5. So before we start, let's take a look at the disclaimer slides first. Alright, so let's have a recap trading the market cycle. So there are four trade types. So in this multi-time frame trend trading strategy, we'll be looking at trend continuation. All right, is to identify a trend and look to take position with the trend. All right, so basically multi-time frame trend trading strategy, we have 6 steps to actually go through. The first step is to identify the higher time frame, or we call it the big picture trend. The next step, step 2, is to determine the potential strength of this big picture trend via the relative strength index indicator, or the RSI in short. And step 3 is to identify support and resistance in the intermediate time frame. So not to worry, later I'll share with you all step by step what is the big picture trend and what is the intermediate time frame. And after supporting the support and resistance, the next step, we call it step 4, is using another momentum indicator, we call it the stochastic oscillator, to determine overbought and oversold condition in the intermediate time frame as well. So for those who wants to recall what is the stochastic oscillator, do refer back to my earlier modules. And for step 5 is to look out for trigger signals from reversal candlestick patterns. So similar as well, I did cover reversal candlestick patterns in my earlier module. What are the reverse key reversal patterns that we should take note of, and that should appear in the trading time frame. And lastly, we will do a bit of risk management, that means i.e. the placement of stop loss. How do I place a stop loss, and how do we calculate the stop loss to be precise, and as well as to calculate the reward risk ratio payoff of this particular trend trading strategy. Alright, so now let's get started. So I'll be using the SPX 500 as my first example. So the first example will be looking at the bullish bias. That means it's a bullish multi-time frame trend trading strategy. So this will be the big picture trend. Alright, is to identify the higher time frame. So this is an example taken off from this year, 26th of Jan 2021. Alright, so as you could see, it start to trade in a series of higher high and a series of higher lows. Okay, so this is considered as a uptrend. Okay, so let's say right now I'm at 26th of Jan 2021 at this time period of time. Since it's trading in an uptrend, I want to know, based on the price action right now, is this trend relatively strong? That means, i.e., will there be a risk of a pullback, or will the price start to push higher at this juncture in time? So to determine the strength of this ongoing uptrend, I will use the RSI indicator as a gauge. All right. So what we could see over here is that there's this bearish divergence that has been formed on the daily RSI. Okay, what do I mean by bearish divergence? A quick recap: we start to see higher high, the last pair of higher high on the price action of the SPX 500. In correspondent, the RSI is not showing the same observation as the price action. Instead, it starts to trade lower high. Okay, as you can see, this higher is lower than this high and is at the overbought region. Okay, so what it means over here is, i.e., the price action has kind of overstretched on the upside. That means we're talking about at this point in time, and the RSI is showing conflicting signals, bearish divergence, instead of what you call it, a similar high is in consideration with the price action, is showing a divergence signal, which means this price action upside momentum has starts to slow down, and the RSI or the RSI is showing the risk of a pullback in price action. So with that in mind, so what I need to do over here is I will wait patiently for a potential pullback to take shape, okay, within this uptrend. All right, so now I will go down to the intermediate time frame, which is the 4-hour chart of the SPX. Okay, so if I look at it, it's similar time period at the 26th of Jan. So I will wait for this pullback to occur. And where does this pullback occur is I want it to stop at a key medium term support level on the 4-hour chart. So you could see that how do I draw support? It could be horizontal support or ascending support connecting the higher lows. Okay, for ascending support, minimum 3 higher lows. 1, 2, 3. All right. So the next key thing is once I identify this support level itself over here, which is at 3680, the next key step is to identify the resistance level as well on the 4-hour chart, and this resistance level will be the intermediate resistance taking from this last swing high here. You could see this last swing high prior to this pullback take shape. So where does it stop? It actually stopped at the previous congestion zone. What I mean by this is a significant congestion zone because price action actually went up from here, didn't do a proper clear bullish breakout from the previous swing high, and thereafter it started to shape a pullback, retest this line and come down again. So this is definitely a significant level of or a resistance level in the intermediate time frame, which is the 4-hour time frame. So that will be my potential exit target for this multi-time frame trend trading strategy. And how do I know that whether this pullback here is about to end at the support level is to look out for oversold condition in the stochastic oscillator. So this stochastic oscillator, due to this multi-time frame trading strategy, I will actually modify the parameter. So to keep it short, to give a brief explanation, this is a slow stochastic. So the slow stochastic would have a general primary parameter at 1433. So since I'm doing multi-time frame, I will actually half the 1433 to actually 533. All right, to make it more reactive towards the medium term time frame, which is the 4-hour time frame over here. So I'll be looking for the stochastic to dip down back to the oversold region. Okay, so what do we mean by this? In a nutshell, once it hit the oversold, that means very likely that the pullback may come to some kind of exhaustion point or exhaustion zone where a potential bullish reversal may take shape. All right, so now once we identify the support level to wait for the price to pull back to this support level, taking into consideration that how do I know the pullback is about to reach its kind of a inflection point before a potential bullish reversal takes shape is by looking at the 533 stochastic oscillator hitting the oversold region level like this at this point in time, and then in the same time frame, the 4-hour, I will actually highlight the intermediate resistance level, which is at 3830. So that will be my ultimate exit target or take profit level in this multi-time frame bullish trend trading strategy. All right, so now once we settle the 4-hour time frame, the two key levels, and waiting for it to hit the pullback to this intermediate support at 336.80, I will go down to the trading time frame. This is where I will actually make my trade decision, means to pull the trigger. Some of us call it the trigger time frame, will be the 1-hour chart itself. So on the 1-hour chart, so right now is that the key principle of multi-time frame is that we are drilling down to the lower time frame. So the higher time frame is for us to determine trend, to determine the exit level, to determine overbought, oversold condition. In this case, bullish will be oversold condition. And second, the last time frame is we got to decide when to pull the trigger. That means when do we actually execute this we call it bullish multi-time frame trend trading strategy is on the 1-hour chart itself. So on the 1-hour chart, I will patiently wait for the appearance of any bullish reversal candlestick pattern. So if you could see here, price came down, hit this support level that we defined earlier on the 4-hour time frame at 3680, and it started to form a bullish 1-hour hammer candlestick. So what does it indicate? Tell us that based on this candlestick pattern is that, hey, sentiment has started to reverse. Previously it was a negative sentiment. Appearance of this hammer candlestick pattern, which is a bullish reversal candlestick right at the predefined support at 3680 with a predefined stochastic oscillator at the oversold condition, giving us a bit of confidence. That means it tends to increase the odds of a potential bullish reversal at this 3680. So from there, I could actually determine now my levels. That means we are already determining the exit. So now it's the entry and as well as the stop loss. So let me touch about the entry level first. So with the appearance of this bullish hourly hammer candlestick pattern, I could actually place an entry order at any price in the next hour candle. That means i.e. at the next hourly price action period. All right. So let's say, for example, definitely, hopefully, we could actually enter at the open, but you know that price is actually moving. So we will try to enter at any best price in the next hour, provided that the price didn't go below the low of this bullish candlestick hammer reversal pattern, which is here. So let's say I managed to enter at the best price, which is at 36.87. So that will be my entry level. So upon entry level, I need to determine, hey, what if I'm wrong? That means instead of price action shaping that potential bullish reversal to go up and hit this exit target, which is my take profit target as determined on the 4-hour time frame, I need to place a stop loss level to tell us that, hey, this movement or this bullish bias is wrong. That means we are wrong in our that means price action goes against our trading strategy. So okay, so let's, before I talk about the stop loss, let's decide the exit first. So we have every trading strategy, there will be two exit. We call it the R1 and R2. So R2 is for me to ultimately take profit, and R1 is for me to take a partial profit. So this is R1, the intermediate last swing high before hitting the support level, which is at 36.78, and R2 will be the resistance that is determined on the 4-hour chart at 38.30. So let me repeat again. The purpose of R1 is for risk management purpose, is for us to take partial profit and allow the remaining position to ride up to hit R2. Then thereafter, I also got to find out if price action do not came in as expected as we want in terms of the bullish biasness. What if we start to reverse down and we got to get out fast? So how do I know that what level for us to get out fast is to determine by a ATR? So let me talk about ATR. ATR, like I covered in my previous module, is a statistical indicator that measures the prior 14 period moving average true range. Okay, so based on this average true range or the last 14 period, it's a moving average, is at 25 points. Okay, so since at 25 points, so what it means that anything that is above 25 points is beyond its average true range. So I actually multiply by a factor of 1.5. So taking into consideration of this support level, so we know that we can't place the stop loss right exactly at the support. This is to prevent us from having this kind of unnecessary whipsaw. So I were to actually place a certain level below this support to act as a buffer. So how much below is, I need to have some statistical calculation. So in terms of statistical calculation, we can use ATR as my statistical guide by multiplying a factor of 1.5. So in this case, the benchmark of the base dollar is either choose the support level or the low of this bullish reversal candlestick, whichever is lower. So since this candlestick pattern here, the low is much lower than 36.80, so to be prudent, I will take the low of this bullish hammer candlestick pattern, which is at 36.64, minus off 1.5, the factor, multiplied by 25, which is points, which is the current ATR at this moment in time upon entry. So this gives me 36.25, so I 0.5, so I round up 36.26. So this will be my stop loss. So i.e., what it means that if the price action refuses to go up and instead starts to travel down, over here I will not close my position because there's a risk of a whipsaw until it hit beyond this statistical average of ATR multiplied by 1.5, which is hitting at 36.26 level. Once you hit 36 level, I'll be actually out of this bullish position. Why? Because it's actually beyond the statistical calculation of the previous 14 period moving ATR. So that will be a kind of a entry level, stop loss, and take profit target. So with that in mind, I could actually calculate whether is it worthwhile to actually execute this bullish position. So if you could recall in my previous bullish breakout trading strategy, reward risk ratio, anything that is more than 1 is considered appropriate, because because at the end of the day my expected reward manages to actually pay my expected risk I'm taking. So how do I calculate a reward risk ratio in this particular trading setup? Is by looking at the expected reward, which is the ultimate level that I want to clear all my position, will be at R2 minus off the entry price, which is 38.30 minus off 36.87. That's give me 153 points. All right, so that will be my expected reward, and my expected risk will be my entry price minus off hitting the stop loss level, which is 61 points. So what it means that over here is that if we are correct, we will manage to get more or less 143 points, because in all, but bear in mind that we will actually take some partial profit of the 37,780 level. So however, if we are wrong, that means at the end of the day, instead of price action going up within the bullish expectation, it actually drop and hit the stop loss, we will actually end up losing 61 points, all right, for this SPX 500. So to calculate the reward ratio payoff, I get 1433. That means the expected reward divided by the expected risk, which is 2.34, which is, I would say, a very pretty much decent trade reward risk ratio that is that we can actually take in this what we call it, bullish bias setup. All right, since it's more than 1. Okay, so let's see how the price reacts. So it actually goes up and hit the R2, then thereafter it just consolidate before moving higher. So all in all, right, because we in terms of trading, we want the price to go higher and higher, but for us trading, we got to be very disciplined. This more on our cover more in module 9 and 10. We talk about trading psychology and risk management techniques. Is once it hit the R2 level, because we already calculate the reward risk ratio, it gives us a 2.34, which is very I would say it's a very good reward risk ratio trading setup. Hitting R2, we should actually take all of our position, close our position, take some money off the table, and reevaluate this scenario again before establishing new position trading setup. So that should probably be how a disciplined trader should work. So once at the end of the day you already come out with your expected we call it, pardon me, with your exit target, we got to actually stick to our rules rather than bending our rules, right? Okay, so now I'll share you more about this trading psychology and risk management techniques in my module 9 and module 10 of this educational series. So now let's us go one more the last example will be this bearish scenario one, which is the bearish multi-time frame trend trading strategy, using the example of dollar versus Canada, dollar CAD in short. So the higher time frame will be the same, will be the daily time frame. So I will identify the higher time frame first. So yeah, if you look at it, the lower high is been and the lower low, it has been kept by below this descending resistance. So for sure this is in a downtrend. So the next thing is I will look out for the strength of this downtrend, because if you recently the price action in the last 2 days here has started to bounce up and now trading very close to the resistance. So for me, I will see that how I want to determine this ongoing current downtrend despite this bounce up. All right. So what we could see now is that the daily RSI is also kept by a corresponding resistance, not at the oversold region. All right, and also there's no bullish divergence. So what it means that what we could see is that this downtrend here is pretty much still healthy. Downside momentum or medium-term momentum still supports this ongoing downtrend, despite this 2 days of green candle that is bouncing. So right now, very interesting. It seems it's very bounced up. That means it's coming very close to the resistance level. So on the 4-hour chart, I should plot the resistance. All right, over here is to determine the price action to snap back to retest the resistance, which is at this point in time, which is 27th of February, at this level 1.2746, and also using the 4-hour chart to determine my exit target. So for bearish position, the support level will, or the last swing low, that will form my exit target or take profit level, which is at 1.2472. So as we could say that on a daily time frame, it already start to bounce up 2 days. So on the 4-hour, it's actually right now testing this descending resistance that I drew on the daily time frame chart at 1.2746. So for sure, I want to see whether the stochastic 533 has it reached the overbought condition to allow us to tell us that, hey, more or less this bounce has already hitting some exhaustion point before what we could say that an intermediate or an immediate bearish reversal could take shape at this juncture, which is indeed pretty much the probability is pretty high due to this overbought condition on the stochastic 533. So with that, what we could see over here is then I could actually now start to look for on the hourly time frame to spot bearish reversal candlestick pattern. Okay, which is here 27th of Feb, this level 24.76. So if you could see over here is that at this point in time, it start to shape on the 1 hour chart this long red candle on the 1 hour time frame. This is why I call that a bearish Marubozu, which is considered one of the bearish reversal candlestick pattern. So with the appearance of this bearish Marubozu on the 1 hour time frame right at the resistance level, and with the stochastic 533 at the 4 hour chart overbought, it actually increases the probability to indicate to us that, hey, this bounce scenario is more or less ended, and right now we may start to see a higher chance of a bearish reversal price action to take shape on the downside. So with that, I could actually start to trigger my entry level on a 1 hour time frame. So we'll be looking at the best price that appears on the next candle, okay, the next hour. So let's say the next best price I could obtain will be at 1.2693. So that will be based on my entry level. So immediately what I do over here is that, what if price action don't goes down? Because we are now attempting to have a bearish time frame, a bearish multi-time frame trading strategy, where we actually take a shorting position first. That means we sell high and attempt to actually buy back lower. So this is what I call a bearish trading setup, an example of it. All right, so with that, instead of price action going down as what we want, but what if price action goes against our bias, our bearish bias, I got to get out fast. So same thing, I need to know what is the statistical movement of this ongoing movement of dollar CAD by looking at the hourly ATR. So before I talk about the hourly ATR, let's look at the take profit target first. We'll call it the exit target. So we have two. One will be S1 is for us to take partial close out of this bearish bias trading setup, and S2 will be S1 will be at 1.2590, and S2 will be at the 1.2472 is the last swing low that we determine on the 4 hour chart. So this is where we got to exit entirely of our position. So these are kind of a predetermined exit level for us to manage this bearish trading setup. So with that, the next key step is to set up the stop loss level. So by looking at this statistical movement of the average true range in the last 14 moving period, it will be at 0.028, which is 28 pips, we call it in FX trading. So with that, I will actually need to determine my stop loss, which will be taking into account of the resistance level 1.2646 or the high of this bearish reversal candlestick, whichever is higher. All right, whichever is higher. So right now what we could see is that whichever the resistance is higher than the high of this bearish candlestick pattern, so I'll be using 1.2746 as my benchmark. Add in a buffer, which is the factor of 1.5 multiplied by this current ongoing 14 period ATR level. At that point in time is at 28 pips, which is 0.028. So this gives you a stop loss level of 1.2788. So what I mean is, if price action starts to hover up over here, and here I will not get out my position, but once it hit this stop loss, that means what we're saying that the whipsaw here is too much, given the 1.5 factor times by the statistical this statistical reading of 0.028. This is where I will actually choose to exit at a controlled loss of 1.2688 at that level. So later I will share you how to calculate the expected risk. So that will be the expected risk I'm taking for this bearish trading setup. All right, so with that, I could have my entry, I got the exit, I got the stop loss. I could calculate whether is it worthwhile to take this position. So I'm hoping for a reward risk ratio of more than 1. All right, so the expected reward I'm taking, it will be the entry level minus of the ultimate one will be S2 will be 1.2472, 1.2693 minus 1.2472. This give me at 0.0221 level. So that will be my expected reward, and the risk I'm taking is if what I'm stop loss I got to get out, so will be the stop loss level minus of the entry level at 1.2788 minus 1.2693. That's give me 0.0095. All right, so with that, that will be saying that I in one position I'll be making potentially 221 pips if we are correct. But however, if we are wrong in in a position or this dollar cap bearish trading setup, we will actually lose 95 pips. Okay, so with that ratio of 221 pips divided by 95 pips, this gives us a expected reward risk ratio payout of 2.33, which is acceptable because it's more than 1. All right, so let's see how the price action goes. Over here, it hit the S1, so this is where in terms of prudency we'll take some partial profit. Then we observe how the price goes from here. It didn't hit the stop loss level, so we are still in position until it hit this S2 here. This is where we are get out of the entire position in terms of a disciplined trader. All right, so I've covered two time frame, one on the bullish bias, one on the bearish bias. So let me share with you all this multi-time frame metrics guide. Okay, what I mean by this metric guide is all determined on, firstly you got to look at it. Okay, so basically we'll break down into time frame first. This is the big picture trend, this is the intermediate trend, and this is the trigger trend. Because the big picture trend, the intermediate trend, and trigger, it all depends on what kind of trading horizon you're looking at. So it will differ from people who are intraday trading, day trading, versus a guy who are position trading or a long-term trading trader. So position trading is actually where I may want to hold multi-weeks to multi-month position. So let's say if I'm day trading, that means I'm only looking to hold my position during the intraday. The big picture trend will be on the 4-hour time frame. The intermediate will be 1 hour, and the way you trigger it off your position will be either the 15 minutes or the 5 minutes. So just now I covered more will be on the swing trading. So swing trading, it may take 1 to 3 days to happen, or even 1 to 3 weeks between this horizon period. So the big picture time frame will be the daily. Intermediate will be the 4-hour, and the trigger time frame will be the 1 hour. So let's say if you are looking for a position trading or longer term time frame, we're talking about multi-month, prepare about 1 to 3 months. Example, you're looking at some stocks that starts to form a very clear long-term trend, be it uptrend or downtrend. The big picture time frame will be on the monthly time frame, the monthly chart. Therefore, the intermediate time frame will be the weekly chart, and the trigger time frame are work off of the daily chart. All right, so with that in mind, I've come to the end of module 7 of Trade the Markets Like a Pro series, and I see you all again in my next module 8.